All right, why don't we get going? So today we are going to talk about rebalancing. So this goes along with our end of financial year series that we're doing, things people should consider as we approach the end of June. I guess now we have to get to June first, then we can approach the end of June. But rebalancing is, I guess, a fairly straightforward topic, but hopefully we'll cover a couple things that make you think a little bit differently about it. But first, anything you hear today is general advice. So I obviously don't know anything about you. So can't offer personal advice, but would love to answer any questions. So I think this is probably going to be a shorter topic. So there's lots of time for questions. So if you have any, just send those through. All right, portfolio rebalancing. So let's start very, very high level and talk about what rebalancing is. So rebalancing is simply realigning your portfolio to where you want it to be. And we'll talk more about risk and return profile in a second. But really what we want to do is take a look at how market movements are altering the makeup of our portfolio. Because of course, as prices fluctuate, and the relative performance of different asset classes in your portfolio are going to change that composition. So I used a very, very simple example here. So it's a 60-40 portfolio of Aussie shares and bonds, and looked at market movements over the last 3 years. And I just used two different ETFs as a proxy for that. So Vanguard Australian shares, of course, and then Vanguard fixed interest ETF, domestic Australian fixed interest. So what we have, and what I'm now looking at potentially poorly labeled columns, is this first column is the returns they experienced in 2002. It's 2001. This is 2000. And what that did to a 60-40 portfolio. So very simply, 2002, we saw Vanguard Australian shares, which is the ASX 300, go down by a little less than 2% in that calendar year. And we saw a lot larger drop in local bonds, of course, as interest rates went up. So close to a 10% drop. So just from that 1 year perspective, we can see that our 60-40 portfolio, if that was our goal, is now at 62 and a little less than 38%. So we can see how those allocations have changed. We see bigger changes as we look in year 2 and year 3, where we had very strong equity performance, not so great bond performance. And then, of course, if we go back to 2000, we can see that as well. So we can see, and we'll talk about tolerances for rebalancing, but we can see, at least in year 2 and year 3, that we have had movements that have taken this portfolio away from where we want it to be. And that is the whole theory behind rebalancing, that of course these market movements will impact your portfolio. And it's an opportunity to go and take a look at your asset allocation, because asset allocation is a huge driver of returns, which we'll get into on this next slide. Okay, so asset allocation. So there is a study that we quote all the time done by Ibbotson, and Ibbotson was a professor who formed an investment management company very focused on asset allocation that Morningstar eventually bought, and it's become Morningstar Investment Management. And he did a famous study where he looked at 90%, or the study conclusion was 90% of the variability of returns in portfolios is because of asset allocation decisions we make. So we talked about asset allocation a little bit, including last week. But really, what we're talking about there is that we want to select the appropriate asset allocation given the goals we are trying to achieve. And there's really two sides of this. If you're a longer term investor, we want to make sure that our asset allocation can get us the returns needed to achieve our goals. And this is because different asset classes have different expected returns. So you, of course, would expect to earn more from shares than you would from bonds or cash over the long term. And so we do need to make sure, if we need a higher return to achieve our goals, that we have enough allocated to those growth assets like shares. The other time that asset allocation really comes into play is investors that have shorter time horizons. assets where they're worried about volatility. They're worried about how much that portfolio is going to bounce around. And so once again, defensive assets, things like bonds and cash, are going to bounce around less in price. So if you're really worried about volatility, then that is something you want to be focused on over that short term, where you don't have that long-term perspective to get the extra return that we would get through investing in growth assets. So really, before we can even think about rebalancing as investors, we need to have this asset allocation target. We've talked a lot about that in previous webinars as we go through the goal setting process, setting our asset allocation after we figured out our rate of return that we need, and doing all of this before we go to what most investors jump to, which of course is picking the individual securities, because that's, I don't know about the fun side of investing, but it's certainly more fun than the other sides of investing, where we go in there and we find what shares do we want to buy, or ETFs, funds, etc. So obviously the first thing we need to do, as I said, is make sure that we have the target. And then when we get to a time where we want to rebalance, and we'll talk specifically about when you want to do that, when we get to that, we have something to compare our portfolio to. So we can go look at our current asset allocation, which has probably gotten out of whack with the returns of individual assets and asset classes in that portfolio. And then we can compare it to where we want it and decide if we need to rebalance, if we've had a shift in that risk and return profile of our portfolio that's been large enough for us to go in there and rebalance. And there's two main approaches that people take with rebalancing. But the first thing that we need to acknowledge is that rebalancing, of course, has downsides. So what it essentially means is we're looking at that relative performance of different asset classes in our portfolio, and the ones that relatively outperform, of course, we want to trim those positions and move money into asset classes that have relatively underperformed. Now, the problem with this is, of course, in any sort of up market, you can have relative outperformance where both go down. But in any sort of up market, what you're typically doing is you're selling your winners, and your winners, hopefully, have generated capital gains. Now, that is bad, right? We want to minimize the capital gains that we pay as investors, because, of course, that's detracting from our return. The other thing is, there are, of course, transaction costs. So anytime you are buying and selling something, you are going to pay transaction costs. So whether that's brokerage, whether that's a bid-ask spread that you are paying, you're still having to pay these transaction costs. And that is a bad thing as well, because we want to minimize costs as investors. So as a result, we do want to be careful about how often we rebalance, and the degree to which we imbalance. So we do want this to occur infrequently. So one technique that people use is they'll just select a periodic time where they will go in and rebalance their portfolio. And generally what we would say is this probably should not be more than annually. Which is why we're doing this, of course, because a lot of people look at their portfolio as we approach end of financial year and make a decision on rebalancing. So we don't want to do this too often, because, of course, every day that the markets are open, you're going to see fluctuations. So we don't want to rebalance too much, or we could be rebalancing all the time. The other approach we can take, instead of setting a periodic time that you will go through and do this, is we can set tolerance levels. And so basically, once again, to prevent us from rebalancing too frequently, we want to look at the allocations we have to specific asset classes and only rebalance when they get a certain percentage away from what we want them. So, you could do 5%, you could do 10%. So if we go back to this original example on here, if we are using a 10% tolerance, we wouldn't rebalance at any point during these 3 years, right? Because what we're making sure is, okay, you've got 40% of your portfolio in fixed interest. Well, no point has this dropped below 30% if we're using that tolerance. So it's another approach we can take. And all we really want to do with rebalancing, like almost everything else that investors do, is it's good to have a framework and some structure around rebalancing. And we want to have framework and structure around the way that we invest because, of course, there's a lot of emotions involved. There's a lot of noise out there with all the news and data that we get inundated with. So having that framework will hopefully lower our behavioral risk or the risk that we do dumb things that impact our overall returns. Oh, very good question, which I will get to. So thank you for that question. But let's talk about another misnomer that investors have: rebalancing versus diversification. So everything that I have said so far has been talking about asset class. So that's these larger groupings of securities. So whether that is shares versus bonds, whether that's growth assets versus defensive assets, looking at these larger scale asset classes. Now, personally, and maybe there's some disagreement out there, I consider that very different than looking at the individual holdings in your portfolio. Now, there are cases where they're the same thing. If you are a passive investor and you are simply investing in, for instance, the securities that I mentioned on the first page, these broad ETFs that you're investing in, maybe they mean the same thing, right? Your individual holdings represent an asset class. But if you're out there holding a bunch of different ETFs, or you're out there holding a bunch of individual shares, there are differences. And I would consider those more diversification. So, right, rebalancing is making sure your portfolio is appropriately aligned to your goals in terms of that risk profile if you're a shorter term investor, in terms of that return profile if you're a longer term investor. Diversification, what we're trying to do there is we're looking at the individual holding level, and we're trying to minimize that security specific risk. So very simply, if I put my entire portfolio into CBA, for example, and something very specific goes on at CBA, so not something that's a wider market problem, but something very specific happens at CBA, and this does happen all the time where individual companies blow up, I want to make sure that I'm appropriately diversified away from that risk. And basically, as you add more holdings to your portfolio, you're reducing that security-specific risk. So the risk that something related to one company happens versus an overall market that goes down, where CBA may go down, but let's say the rest of the big four banks go down as well, as opposed to something really happening at CBA. But this is where we get into some interesting debates around diversification. And there's all sorts of different things that we hear about diversification. But one thing we should know, and there's a good Buffett quote, talking about, I think he's talking about a garden, right, where he's letting his flowers bloom and the weeds wither away. So basically what that means is backing winners and letting those winners run. We should think a little bit about the market in general and where returns come from. So there's a study that was done that represents these first two bullet points by a professor out of the University of Arizona that was just going back and looking at overall market. And so the first study he did is he looked at the US between 1926 and 2016. And while it sounds like a lot, he found that the top performing 1,092 listed US companies, which is only 4.31% of all the listed shares during that time period, accounted for all of the wealth creation from investing. Now, when he was referring to wealth creation, he was looking at returns in excess of T-bills. So treasury bills, a very short-term government fixed interest security, and generally fairly low returning. And very narrow amount of shares, 4.31% of them, really generated all those returns. So number one, that's something to think about if you're out there picking individual shares, that most of them are not creating wealth over the time. It's about finding the right ones, which are the ones, of course, we always hear about. And he did this in global markets as well. He looked at 42 different global markets, shorter time period, just from a data perspective, and he did this study, or this portion of the study, a little bit later. So between 1990 and 2018, 811 companies, or only 1.33% of the total companies listed globally during that period, created all that global wealth creation. So it is something to be cognizant of in terms of letting your winners run. So it does mean that over a long time period, unless you are a really, really good stock picker and you just happen to have selected for your whole portfolio all the shares that are the ones generating all this wealth, what it means is that your portfolio and the overall returns of your portfolio are likely to be driven by a small amount of shares in it as well, all things being equal. And then there's this interesting article in First Links that was looking at Australia and went back and looked at how many companies have ever been listed in Australian exchanges. So this is back in 2019. So 37,000 companies have ever been listed on an Australian exchange. And there were a bunch of them before things got really consolidated within the ASX. And of that 37,000 companies, 33,500 of them were delisted. So basically being delisted essentially makes a share worthless at the end of the day. So they have fallen, they've either been delisted by the company or they've been delisted by the exchange because they've fallen below some threshold, which generally has to do with the share price and the market cap of those shares. So you don't want things that you buy to be delisted. So a lot of those companies were essentially worthless. 1,200 of those 37,000 companies were bought by other companies, which in general, depending upon when you got into them, is a positive for investors, at least in the short term, because you're going to get a little bit of return surge there. And then there are 2,300 companies remaining that remain listed in 2019. So once again, showing that in Australia as well, over the long term, that very few companies are really responsible for a lot of the wealth generated by investors. So something to think about with diversification. We'll talk about some different techniques you can take there. But remember, these are different things. These are very different things between rebalancing and diversification. But I'll talk about the implications in a second. So David says, so the odds are against being able to pick wealth creating stocks, so just invested in index ETFs. Yeah, I mean, listen, that's certainly a takeaway from this. That, we hear all the time about these companies, and generally when we hear about them, they're very large companies, but remember, they probably didn't start there. We hear about these companies and we hear these amazing returns that have been generated, thousands and thousands % returns that have been generated by certain companies. But yeah, they are hard to find. And they're especially hard to find if you want to get in early. Because, one of the things that I talk a lot about is sort of the style of investing and finding appropriate investments for obviously what you're trying to accomplish, but also sort of your temperament, your investment philosophy. I tend to favor big companies, but certainly if you're going in and buying big companies, there is probably a lot less risk, or there is a lot less risk that they're going to go bankrupt or get delisted. But at the same time, you probably left behind many of those returns, right? It's the people that went in there and bought Apple when Apple first was listed and saw the potential or got lucky investing in Apple versus someone who might buy it now, where it's a very large company. And while the returns have been good over the past couple of years, there's a limit, of course, to how big Apple can get. And so you probably left behind a lot of those returns. But yeah, I think, David, it's a good observation around the challenges of going out there and picking shares. All right, so I'll go through a couple of tips, and then we've got some questions we'll go through. And this is for rebalancing, but also I'll add in some stuff around diversification. So obviously, as I said before, there are tax impacts from doing this. And of course, there's transaction costs. So we want to do it as little as possible. And while there is certainly value from diversification or value from rebalancing and certainly value from diversification, we do want to limit how much we do this, which I don't think is talked a lot about with rebalancing. It's supposed to be just kind of this hygiene thing for our portfolio that we go through. But if we can avoid it, let's avoid it. So the first thing is cash. And we'll spend a couple minutes on cash. So cash is something that I think is very unpopular with most investors. It's getting a little more popular, frankly, now that interest rates are higher, but we also have really high inflation. So we are, of course, that cash is losing its purchasing power over time. But cash can play a really important role in your portfolio, and one that I think a lot of investors don't appreciate. And basically what cash does is it makes rebalancing easier. If you're holding some cash in your portfolio, it allows you to go in there and buy the relative loser in your portfolio and get that allocation up without any tax implications. So think about cash, think about the ways you can use cash. The other thing you can do with cash is, of course, that can offset other risk in your portfolio. So cash would be considered a defensive asset, but holding a cash balance can also offset individual shares or potentially in ETFs if they're a little more narrowly focused that have become a disproportionate part of your portfolio. So don't discount what cash can do in your portfolio. So it's obviously taking advantage of opportunities, but it can also help you with rebalancing. So if you build up a little cash in your portfolio, it's not the end of the world because it'll just make that whole rebalancing a little bit easier. The other thing, of course, to think about is when rebalancing is generally discussed, it is sell your winners, buy your losers. Well, if, and this is very specific to investors and kind of where you are in your investing journey, but if you're continuing to contribute into your portfolio, then you can use that as a method to essentially rebalance. And you do the same thing with income generated from your portfolio. So remember, that is cutting off that whole selling side, which is a good thing because that's what generates tax consequences. And it allows you to go in and rebalance your portfolio using those contributions you're putting in and using income generated from your portfolio. And then kind of this final step is maintaining these tolerances. So we have to really think about, and we can do this by looking at the different expected returns from asset classes. We have to think about, okay, if your portfolio, if you're going for 60-40 and all of a sudden you're at 62-38, how big of an impact is that going to have over the long term? Probably not a lot. Now, it could have a really large impact if all of a sudden you are at 70-30, for example, but making sure that we use those tolerances. So we talked about the two different techniques of rebalancing, but it's also worth noting that you can combine them as well. So we can take this tolerance approach, but we can also go in there and make sure that we are only doing it periodically. So that we're not in there all the time as we get each fluctuation, as we sort of break out of those tolerance bands that we've set, that we're kind of continually potentially rebalancing in a very volatile market. And the same things would play out when we're looking at diversification. So everybody's going to be different. Everybody's going to be willing to take on a certain level or different levels of security specific risk. And what I'm really talking about is how large of a position does an individual holding make up of your portfolio? And people are going to be comfortable at different levels. So there's certainly this school of thought that I don't want to dilute all of my good ideas by holding 100 shares. And so if I'm going in there and I'm having 1% of my portfolio, why would I dilute my 20 best ideas by going in there and investing in my 21st to 100th best idea? So that's one thing. The other thing in terms of diversification is, of course, if you're holding individual shares, there does get to be a point where you are more and more replicating the index. And if you are, of course, coming close to replicating the index, then perhaps it's best just to invest in the index. So that's another thing that investors think a lot about in terms of the way that they're constructing that portfolio. And you can do the same thing with diversification with individual shares in your portfolio. And just remember, you're potentially paying, depending upon how long you held something, you are paying a lot in tax, and capital gains tax if you go in there and sell something. So obviously, depending upon if this is in a super account, this is outside of super, there are all sorts of different implications, but think about that tax implication of selling something and think about, are there other ways I can do this? Can I just add more money to my portfolio through these periodic contributions, which will of course lower the percentage in each one of these shares? Can I take income generated from my portfolio, maybe turn off a dividend reinvestment if you use that in some of the largest holdings in your portfolio and divert that cash elsewhere? Are there ways that you can minimize how much is in an individual security without having to actually sell it? And, to go back to that Buffett quote, give those winners a chance to actually run. And there is no right answer or wrong answer to that. But because an individual holding in an individual share that we might own could always go to zero. Something could always happen where that company goes bankrupt, or it could be very large losses in an individual share. Think about what the implications would be on your goal if that were to happen. So if you go in there and own something that is 10% of your portfolio, what would happen if that went to zero? Would you ever be able to make that up? If you can't, then perhaps that is a time to trim that position a little bit. And obviously trying to do that in a tax efficient way. All right, we've got some questions, which is good. All right, so we've got a question. Do you ever consider your primary residence, so the home that you own and live in, with a mortgage as a defensive asset for allocation purposes? Include home as a defensive asset. What about residential rental properties with a mortgage? Difficult to rebalance given large amount and liquidity. Okay, so let's talk about how we should think about something like a home in terms of our portfolio. One, obviously, with the price of real estate, it is a very large asset for thinking about it from an investment perspective. But let's talk about your primary residence first, and then we can talk about investment properties that you have. My question for anyone who's considering their primary residence as part of their portfolio is to, once again, think about why you're investing in the first place. So a simple reason why people invest is, of course, they invest to provide for their retirement. So that's almost a goal that's universal. So it's a good one to use. My question then, if somebody's considering their primary residence as part of their retirement, is how is that going to contribute to your retirement? And there's really two different ways that you can do it. The first way, of course, is if you're able to pay off your mortgage. So, of course, if you're able to pay off your mortgage and you then remove basically that expense from your life, that is a huge way that your primary residence can benefit your retirement. Because of course, then when you're looking at your portfolio and the spending needs that it needs to support, well, that's great. There we go. We can remove what is generally, for most people, their highest single expense. We can remove that from the cost of retirement. So that's a huge way a primary residence can help support your retirement. And what I think more about that is, and depending upon your personal situation, is then you're really thinking about contributions, right? Am I putting more into my portfolio, or am I trying to pay off my mortgage faster? Just remembering that the problem with mortgages is, of course, you need to get to the finish line before there's any impact. All right, you can make all these principal payments for years and years and years, and essentially gets you nothing. You own more equity in your home, but it essentially gets you nothing until you get to that finish line from a cash flow perspective. The other way that I think a home can really contribute to your retirement is if you are planning on moving. So whether you are downsizing and planning on moving into a smaller home that does not cost as much, that can be a big influx of cash when you sell it. So that is something to think about. And the other thing you can think about is, of course, if you're moving to a cheaper location, it can be a source of cash. In terms of asset allocation, it's a little bit tricky. People, I see why you would say a defensive asset. I think it certainly can maybe be considered a defensive asset if you were going and trying to pay off your mortgage. But there is some volatility in the prices of homes. And if we go back and sort of look at the kind of risk and return profile of Aussie real estate, at least historically, in the past 30 years, if anything, it's looked more like a growth asset, right? With a level of returns that people have gotten from residential real estate, looks a lot more like a growth asset than a defensive asset. So, prices mostly have steadily gone up. Either way, they've gone up over the long term. In terms of volatility, I guess, the volatility really is, and when we think about volatility over the long term, really the only thing that we're worried about is that it makes us do something stupid, right? And one of the things about homes is you sit there and you get a sense, of course, that real estate is going up, and you read the paper and you can see that in aggregate it's going up. But it's not like the share market where somebody's showing up every 30 seconds telling you how much your home is worth. Because with volatility, we're very worried that volatility would make us do something stupid over the long term. And chances are somebody kept coming up and ringing your doorbell every 5 minutes telling you how much your house was. There's a lot of barriers to you actually selling it, right? So it's an illiquid asset. So it's not like you're going to make some snap decision if somebody shows up at some point and tells you your house is worth 20% less. So it's kind of hard to think about. In terms of investment property, which is the other part of the question, once again, I would go back and I would think about, okay, how do you see that property? What's the primary purpose of that property? Are you investing in that property because at some point you see this as an ability to get cash flow out of it? So you see that the amount that you rent it out for is going to be less than the cost? Or are you really going out there and looking at that as more of a capital gain generator? And are you going to sell it? So yeah, it is very difficult to rebalance. The only way I'd say you could rebalance is by looking at the leverage in your home. So certainly, you paying off more of your mortgage is deleveraging that investment. It's essentially you putting more money into that house. Because even if your house is worth $1 million and you put down 20% for that, you've really only put $200,000 with a bunch of leverage into that. So that's one way we can leverage and deleverage. And, we can go out there and get loans out from our home as well. So that's the other option. But yeah, it's a little tricky to sort of consider that. So I just think about what your ultimate intention is of that house. All right, I've got another question. Is there any merit in setting a cash allocation of 3 to 5 years of living expenses, and whatever the market value of my shares are will determine my allocation mix? Yeah, and kind of depending where you are, Grant, you're in retirement or approaching retirement or anything else. Yeah, once again, I think cash is very underrated, personally. And in two different ways. Like, number one, when we look at defensive assets. So I looked the other day, and I think an Aussie 10-year government bond was trading at something like 3.8% for a 10-year bond. Well, I can exceed that using the bank that I save with, ING, with a term deposit. Now, of course, that's a 10-year bond. You can lock that in if you buy the individual bond, and there's no way that my 120-day term deposit will be at the same rate. That'll be vary based on interest rate levels. But yeah, I think there's a lot of value in cash. And I think certainly setting aside a cash allocation of 3 to 5 years of living expenses does make sense. If you are sort of doing, and honestly, this is kind of what I've done with my mother, is that she holds a lot of cash, and then everything else that she has, if she's retired, is in shares. I would say they're in less volatile shares, big dividend paying companies, kind of taking that sort of, taking that approach where we're going ultra safe, ultra low volatility of cash, and then putting more into shares. I think that does make sense. I also think that, when we're looking at overall asset allocation, we're not going to put everything we have into that from a portfolio perspective, right? An emergency fund would generally sit outside of what you were looking at for what we would consider your portfolio. So I think that makes a lot of sense, Grant. That's essentially what I did with my mother. But yeah, that's my 2 cents, I guess, on cash and setting aside living expenses for it. All right, so we got another question. Say you have a number of ETFs linked stocks, which make up your 60% of stocks allocation, small cap REIT, listing a couple different ETFs at different target allocations. Individual allocation might change, but overall still 60%. How important is it to rebalance at this level? Yeah, so this is, I guess, the part that I left out, right? So I looked at rebalancing from an asset class level, and then kind of called those individual securities more of a diversification play. And what I would say is sort of allocations within those larger buckets are kind of in the middle and have, I guess, characteristics of them both. I wouldn't spend a lot of time, this is a personal opinion, I wouldn't spend a lot of time reallocating between those different, at this point, so different allocations within shares. Because once again, trying to minimize the taxes you pay and the transaction costs. I think that's certainly an area, well, each one of those buckets, whether it's global shares or REITs or small caps, well, each one of those will have different risk and return profiles or perform differently in different environments. I think if you're spending a lot of time rebalancing, that ultimately would probably be to your detriment. That if you're still sitting there and comfortable from a growth perspective, that you have enough allocated to shares to get your returns, even if things move around within those allocations, I would think of other ways to kind of even that out. And whether that's just using income to do it that your portfolio generates or new contributions, I think going in there and rebalancing, and you can divide up your portfolio, even not at the holding level, you can divide up your portfolio in lots of different ways, sort of sub-asset class. I would say for most investors, that is probably getting a little too cute, and you're ultimately going to impact yourself. You're ultimately going to end up in a worse place with all the capital gains and everything else. Now, that is my opinion, but I think it's about kind of thinking about what is right for you. But I think with most investors, what's right is minimizing taxes and transaction costs. All right. So yeah, capital gain in the value of primary residence could also be used as a source of leverage to invest in stocks if you're happy with this risk. Yeah, it can be. Anytime obviously you're using leverage, just be very aware of how that kind of changes the risk and return profile. So anytime you're using leverage with something and it goes up in value, and this is why returns have been so great for investors with real estate, is because there's generally a lot of leverage involved. So even if housing prices are going up, let's say 7% a year, you're still earning a return way higher than that because of all the leverage you've had. So anytime you put leverage into something, whether that's your house or whether that's shares, if they go up, you're multiplying that return that you receive. But just remember, you're also introducing a lot more risk on the downside. So of course, and I think a lot of people got in trouble with this in the last couple of years, where they've gone out and borrowed money for shares, kind of particularly in the US, where we see more fluctuations in value. And last year was a lot worse of a year. Just be very careful about the risk that you're introducing by using leverage. All right. So Rodney says, I understand not including your primary residence part of your portfolio. However, could you consider it from the perspective of asset allocation portfolio? You have paid off your house. Could it be considered that investing extra in, say, REITs could be overweighting your overall net wealth towards property. Technically, it's a value. Could even be considered a bit of tilt to your overall asset allocation, home bias. Yeah. The only comment I would make there is it depends upon what REITs you are investing in. I think that, the profile of your house versus a office building versus owning a mall, something like that, are very different. So I think just a lot of the listed property we see is pretty different than the drivers of your home. The other thing I would say is, Australians in general are very, just because of the value of real estate, and I think the popularity with a lot of people around investment properties are probably, yes, very, very, I don't want to say over allocated, but there's a large allocation to real estate. So yeah, I think as you're going through and looking at different types of REITs and trying to figure out, okay, what are the drivers of those returns and the risks associated with the REIT versus a house? Yeah, they could be very different. And I guess sort of, an example, and this is a dumb example, but I'll give it anyway. During COVID, when people started working from home more, and a lot of people that are still working from home, we saw a lot of appreciation in regional real estate, right? So somebody figured, and I'm just using this as an example because I know someone who lives up there, I'll go live in Port Macquarie instead of Sydney. And so you had all these people that were living in capital cities and were moving out into regional areas saying, well, who cares? I'll just work from there. And so we saw a lot of appreciation in that real estate. Now we're starting to see some issues with office REITs, for example, as less people are coming into the office and a lot of companies are shrinking their footprint in a lot of these office buildings. We're starting to see some issues there. So I think that would be an example where we're actually seeing, okay, well, regional real estate really has a very different risk and return profile than offices. So yeah, I would think through sort of the different REITs that you're potentially investing in and where that exposure is and what those drivers are of how those REITs do. All right. Well, I think we've just had a very short one today because, how much can you talk about rebalancing? Although it is 1:42, I noticed. But anyway, thank you guys very much for joining. Some good questions today. And I guess we're doing this again on Thursday night, right? The end of financial year checklist. Emily is nodding at me. I'm not just talking to myself. So Thursday night, we'll go through sort of an end of year checklist. And if anyone would like to join that, it doesn't have a invitation. Just shoot me an email and I can get that. Or I can send you the invite. All right. Thank you guys very much.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.